It is March 4th, 1933. Franklin Roosevelt has been president for 6 hours. By midnight, 32 states have declared bank holidays. By morning, every bank in the country is closed by federal order. Somewhere between $9 and $12 billion in deposits, no one knows the exact figure, is simply unreachable. People show up to their banks and find locked doors and handwritten signs. Eugene Meyer, governor of the Federal Reserve, has not slept in 3 days. In a townhouse on East 65th Street in Manhattan, a man named Winthrop Aldrich, chairman of Chase National Bank, son of Senator Nelson Aldrich, is on the telephone with his estate attorney. Not about the bank crisis, about something else entirely. His attorney is telling him that a specific pool of capital his family holds is untouched by the holiday. Not frozen, not locked, available. The attorney uses the phrase, outside the commercial system. Winthrop Aldrich already knows what that means. He grew up knowing what that means. His family had been keeping money there since 1902. The Aldrich case is not famous. It does not appear in the standard histories of the Depression. It shows up in fragments, a footnote in a 1967 Columbia University oral history project, a passing reference in a legal filing from the 1940s, a single paragraph in a privately printed family memoir that was never sold in bookstores. To piece it together requires going to the sources directly, which is how most of what old money actually did stays invisible. It doesn't hide. It just never gets a press release. What Winthrop Aldrich's family held and what remained accessible on March 5, 1933, when the rest of America was locked out of its savings, was cash value inside a participating whole life policy with a mutual life insurance company. This is the center of the case file. Everything else is context. A mutual life insurance company is a specific legal structure. There are no shareholders. The people who hold policies with the company collectively own it. When the company earns more on its investment portfolio than it needs to pay claims and expenses, the surplus does not go to outside investors. It comes back to policyholders as a dividend, not a stock dividend, a return of overpaid premium, which is classified and taxed differently. In most years across the 20th century, the major mutuals paid between 4 and 6% on accumulated cash value. Guaranteed floor. Dividend above that. During the bank holiday of 1933, commercial deposit accounts were frozen. Brokerage accounts were frozen in many states, but insurance cash values were governed by state insurance law, not federal banking law. The holiday order did not touch them. A policyholder could still request a policy loan against their cash value. The insurance company was still open, still processing requests, still functioning exactly as it had the week before, and the year before, and the decade before. This is not a coincidence of timing. It is the structural difference between a custodial account and a contractual right. When you deposit money in a bank, the money is legally the bank's. You are an unsecured creditor. The bank owes you a liability on their balance sheet. If the bank closes, that liability gets frozen with everything else. When you hold cash value inside a life insurance policy, you hold a contract right against the insurance company, a specific named claim with legal standing under state insurance code. It exists regardless of what the federal government does to the banking system on any given weekend in March. Winthrop Aldrich knew the difference. His estate attorney knew the difference. The branch manager at the local Chase, one of the banks Aldrich himself chaired, did not explain this difference to retail depositors, because the retail depositors' money sitting in the bank was exactly what funded the bank's lending operation. The bank needed those deposits. It had no structural incentive to redirect them somewhere else. Go back to 1902, when the Aldrich family began building this position. Nelson Aldrich, senator from Rhode Island, the most powerful finance legislator of his era, was already skeptical of commercial bank deposits as a place to hold serious capital. He had spent years in proximity to the men who ran banks. He understood how bank runs worked. He understood that a bank's solvency was a confidence game as much as an accounting one. A bank could be technically solvent and still fail if enough depositors showed up on the same Tuesday asking for their money back. The mutual life insurance companies did not have this vulnerability. Their liabilities, death benefits, were contractually defined and actuarially predictable. They did not face runs. A policyholder did not panic and cancel their policy because they heard a rumor. The cancellation value was defined in the contract. The company could meet it. The structure was slow by design, and that slowness was the feature, not the limitation. Nelson Aldrich began moving family capital into participating whole life, around the time he began his 3-year study of European banking dynasties, the same study that would eventually feed into the design of the Federal Reserve. The European families he studied through agents in Geneva and Amsterdam and London were already 2 and 3 generations into these structures. The Swiss private banks that manage capital for old families did not keep significant liquid assets in commercial deposits. They held bonds, real estate, and participating insurance contracts. The insurance piece was not the conservative fallback. It was often the core. His son Winthrop absorbed this understanding the way children of those families absorb most of their financial education, not through formal instruction, but through proximity to the decisions and the language around them. By the time Winthrop was in his 40s, running Chase National Bank, he had spent his entire adult life watching what banks do with other people's money. He kept his own elsewhere. The mechanics of how the Aldrich family used these policies can be reconstructed from estate filings with enough patience. They did not buy standard whole life policies the way a middle-class family might buy a policy to cover a mortgage. They bought participating policies from mutual companies, primarily Penn Mutual and New York Life, and funded them at the maximum level the contract allowed. The excess premium above the cost of insurance went into paid-up additions, which are additional increments of coverage and cash value that vest immediately and begin earning dividends right away. The effect is that cash value builds faster than in a standard policy because you are not waiting for years of premium payments to accumulate before the investment component begins to function. By year 5 of a well-funded policy, the cash value is substantial. At that point, the structure begins to function as what practitioners today call a private banking system, though that name came much later. The policyholder borrows against the cash value at a contractual rate set in the policy. The loan is not a withdrawal. The cash value continues to earn dividends as if the loan balance did not exist, because the insurance company is using its own capital to fund the loan, and your contract value remains intact as collateral. The borrowed money goes to work elsewhere, in real estate, in other investments, in business operations. If the return on that deployed capital exceeds the loan rate, the policyholder runs a positive spread. They repay the loan when it makes sense, on their own terms, with no bank approving the timeline or imposing covenants. Done over 2 or 3 decades across a family with multiple policies, this creates a pool of capital that operates entirely outside the commercial banking system. It does not appear on a brokerage statement. It is not held in the bank's name. It does not freeze when the government closes the banks for 4 days in March. It simply sits there, compounding, accessible on request, governed by a contract that was signed years or decades before, and cannot be unilaterally modified by the company or the government. The Aldriches were not the only family running this structure in 1933. The Mellons had been doing it since the 1890s. The DuPont family had significant positions in mutual life contracts that appear repeatedly in their estate filings from the 1930s and 1940s. The Phipps family, Henry Phipps, had been Carnegie's business partner and walked away from the steel sale in 1901 with $50 million in cash. moved a substantial portion of that capital into mutual life structures within 3 years of the sale, on advice from the same New York attorneys who handled Carnegie's own estate planning. These families had no coordinated strategy. They arrived at the same structure through separate paths because the structure had genuine advantages that became clear to anyone who spent serious time thinking about where to hold liquid capital across generations. The post-1933 period is where the case file gets interesting. After the bank holiday ended and deposit insurance was created through the Glass-Steagall Act, commercial banks became safer for ordinary depositors. The FDIC changed the calculus for people with modest savings. The risk of losing your $500 savings account to a bank run was now largely eliminated. This is a genuine improvement. It is also, from the perspective of families holding large pools of capital, largely irrelevant. FDIC insurance protects deposits up to a limit. The limit in 2024 is $250,000. A family holding $2 million in liquid capital is protected on $250,000 of it. The other $1.75 million is an unsecured claim against the bank. In a failure, that claim goes into the general creditor pool. The family is in line with everyone else. The mutual life insurance structure, by contrast, is governed by state insurance guarantee funds with separate coverage limits, and more importantly is held as a contractual right, rather than a deposit liability. The legal position is different. The failure scenario is different. The wealthy families who understood this did not stop using the structure after 1933 made bank deposits safer. They kept using it because the safety improvement at the low end did not address the actual problem at the high end, and because the compounding advantages and tax treatment remained intact. And because the privacy function, the fact that a life insurance policy does not appear on a credit report, is not subject to the same public disclosure requirements as a brokerage account, and passes to heirs through the death benefit without going through probate, remained valuable regardless of what happened to FDIC limits. There is a document trail here that is worth following if you're willing to go to probate court archives. When a wealthy person dies, their estate goes through probate unless it passes through structures specifically designed to avoid it. The life insurance death benefit is one of those structures. It passes directly to the named beneficiary. No probate filing, no public record, no list of assets that a creditor, a disgruntled heir, or a journalist can access through a court request. The Rockefeller estate filings from the 1930s and 1940s are surprisingly sparse for the scale of wealth involved, which is itself the tell. The capital was held in structures that didn't show up in probate. The strategy has a name now. R. Nelson Nash, a former life insurance agent, published a book in 2000 called Becoming Your Own Banker that gave the approach the term infinite banking concept. Nash did not invent the mechanics. He described what old money families had been doing for a century and gave it a name that could be marketed. The marketing has been mixed in its effects. The name attracts people who want a shortcut. The actual strategy requires patience, capital, and a willingness to fund a policy for years before the structure performs at its potential. People who approach it as a product rather than a long-term structural decision often get poor results and blame the instrument. The instrument is not the problem. The instrument has been working the same way since the 19th century. Penn Mutual has paid a dividend to participating policyholders every year since 1847. Through the Civil War, through the Panic of 1873, through the Panic of 1907, through the Great Depression, through the stagflation of the 1970s, through 2008, through the pandemic. The number has varied. The payment has not stopped. The families that understood this in 1902 were not smarter than everyone else. They had access to counsel that explained the mechanics clearly. They were in rooms where the right questions got asked and answered without a commission attached to the answer. That access is what separated them from the retail depositor, who opened a savings account at Chase and watched it freeze behind a locked door in March of 1933. Winthrop Aldrich got through the 1933 bank holiday without a financial disruption. He then spent the next several months publicly advocating for stronger banking regulation, which he genuinely believed in, and which also happened to restore confidence in the commercial system his family's bank operated. He was good at holding both things at once. That is a skill old money families tend to develop across generations. His family's private capital, sitting in mutual life contracts outside the commercial system, compounded quietly through the decade. It required no rescue. It attracted no headlines. It passed to the next generation in a form that did not require a probate filing to document. The savings account his depositors held at Chase earned 2% in a good year, when the bank was open, which in 1933 it briefly wasn't. Pay attention to the difference between what a financial institution recommends and where the people running that institution keep their own money. The gap between those two things is usually where the real education is.